Today would be another good chance to show you why selling puts is a really cool thing. So I sold this $30 put on HIMS back when it was still at like, I don't know, $32 or something. So I am getting absolutely clobbered on it, as you can see. But remember, when you sell puts, you're just putting up collateral to buy shares at a certain price. So I'm going to buy 100 shares at $30 when this expires, regardless of what the price of HIMS is. So this total return isn't really true, but that's about how much I would be down on my position. Well, it'd be more than that. I'd be down, let's see, like $1,200 from a $30 assignment. But you see how it says break even $27.35. So that $9.98 is how much I'm down from $27.35. So obviously I'm not going to sell this. I'm just going to let the shares get assigned so I keep that $265 credit there, right? But what I did is, since HIMS is literally down 50% from when we did this, I sold another put here for the $16 strike, and you can see here my break even is $13.90. So, but this is actually up because the price is up since I sold this put. So let's say that I get assigned on the first one and not the second one. I'll end up keeping the credit on this of $210 and the credit on the other one of $265. So that would be a total of just shy of $600, right? If March comes around and HIMS is above $16, that's what would happen, right? Is I would make about $560 something, $575 in credit, right? And I would be down about 200. Well, if HIMS was at, say, 25, let's say, right? Just for simple scenario here. I would be down $500 on my 30 strike position, but I'll keep the entire credit of each of the put sells, and I'd actually be break even. So I would have made money a little bit or broken even though the stock is down $5 or, 10% or whatever. I don't know what that is. More than 10% from when I technically bought it, right? So what I'm trying to show here is, like, selling puts during a decline is a really, really good way to make money, because you're buying stocks that you want to anyways, and if they continue to fall, you're saying, okay, well, if I get assigned at this price, I'm happy with that. That's fine. And you get paid a lot of money to do so because because volatility is up, the premiums on the puts pay better than normal, right? So, like, another thing I did here is on Friday, when the market recovered really strong, Path popped up pretty good. Like you can see off the bottom here, we're up like $2. So on Friday, I sold calls against Path for $17, which means as long as we get to March 20th and Path is under $17, then I just get to keep $88 because I sold two of these, right? And if it is above $17, then it'll sell my shares, and I'll still keep the $88, and I'll make $4 a share or something like that. Let me see my averages on Path. $13.70, so $3.30 a share is what I would make on 100 shares. So that's $330, right? So I make $330 and the $88 for a total gain of $500. I don't think it's going to get to $17 by March 20th, which is why I did that. I really just did it to hedge my position and collect some free income. So, as I have said a million times, the best way and the way that options are supposed to actually be used is you're supposed to be a seller of volatility and use them as a hedge or collateral, not to gamble a long time. But sometimes it makes sense to do so. Like, this spread is doing great. It's up 80%, right? And if we get into the 425 to 440 region, this is going to be up several 100%. And looking at the gamma exposure on the trading view, I do think that that's quite possible. So, sometimes it makes sense depending on where you're at and how much a stock is down and what you're seeing in the markets to do naked options. But generally speaking, the way options are supposed to be used is as hedges or as volatility selling opportunity. So that's what we are doing with both of these HIMS put sells and the covered call sells on Path. So yeah, just thought I would share an update on that, because even though I'm going to be quote unquote down on this HIMS position, right? If I was to get assigned on both, I'm still going to make $500 something, and my break even would be closer to 16 than it would to 30 because of how I've done this. So just thought I would share. That's a way you can repair or average down a little bit more strategically when you're selling puts, right? Like I'm definitely gonna get assigned on a 30. There's no doubt about it, right? And you can see I sold this put at 265 and it's now 1258. That would have been a 6x if I was a buyer there, right? But who could have possibly seen that whole lawsuit thing was going to happen? Not me. But that doesn't change the fundamentals of the company, and to me this is just a buy the dip and wait opportunity. It is. So him's average price target's like $40. So in theory, if I get assigned on both even, and my average is under 20, that's a huge win long term. So patience pays, my friends. The stock market is a tool of transferring wealth from the impatient to the patient. Remember that. Have a good one.